All right, the latest Canadian inflation report came in hotter than expected, and those rising price pressures are there despite a tax holiday for consumers. Joining us now with more on what it could mean for interest rates is Robert Both, Senior Macro Strategist with TD Securities. And Rob, thanks very much for joining us. We'll jump right into the numbers. What are you seeing? What did you see in the latest numbers?
So the headline CPI was unchanged. It was 1.8% in December. It actually increased a little bit to 1.9% in January. But I think the big takeaway for us was just the bank's core inflation measures were considerably hotter than we or the market expected. The two core inflation measures that the bank looks most closely at are now running at 2.7% year over year. So they are getting closer to the upper limit of the Bank of Canada's target range. And that is despite the downward pressure we've seen from this tax holiday on some of those other components. So you did see that drag continue in January, while the December CPI report already showed a large impact for things like restaurants, alcohol, recreational goods and services. We did see that continue into January, but you also had large increases to energy prices offsetting that, gasoline, heating fuels, and natural gas as well. Obviously, it's been a very chilly month and certainly a chilly February as well. So those two forces really offset each other this month, and that left total inflation actually slightly higher despite those tax cuts putting downward pressure on the headline.
Okay, you talked about energy, you talked about restaurants. Were there any other key highlights or trends that you noticed within the report?
Yeah, I think there were a couple. One is on the more hawkish side, kind of large household goods, things like motor vehicles, furniture, appliance, items that might be financed by credit. Those are showing more signs of stronger price pressures over the last couple of months. So that is something that might get the Bank of Canada's attention as they're focusing more on the consumer and how rate cuts are feeding through the economy. Now, on the more dovish side, one area where inflation has taken a very long time to come off has been shelter prices. And we are starting to see more and more evidence of shelter inflation coming off. So rents actually posted their first month-over-month decline in about 2 or 3 years in the January CPI report. So while we're seeing this in the rental market itself, that is just capturing prices for one specific apartment. This was a drop in average rents across the country, and as that continues, we are going to see more and more of that shelter inflation come off over the next 12 months. So there are, on one side, those areas that are going to receive the largest response from rate cuts. They are starting to show signs of responding, but also these areas where inflation has been very slow to decelerate is finally starting to gain some traction there. So I think there are a couple of different ways the Bank of Canada can look at that.
Okay, so given that backdrop, how does this set things up for the Bank of Canada when it comes to policy next month?
Well, I think for the Bank of Canada, their focus is going to be on the core inflation measures. And as I said, with the last couple of months, those are now sitting a little bit closer to the top of the Bank of Canada's target range, certainly more close than they would like to see. Now, the bank has expressed some skepticism on just how these core inflation measures are calculated, so they are looking at a broader range of indicators with a broader focus on underlying inflation. And if you do look at some other measures like the previous CPIX or an ex-food and energy index, those are showing a little bit less heat. But I think the strength you're seeing in core measures has the market questioning whether the Bank of Canada is going to be in a place to continue easing in light of that stronger inflation momentum. So we still look for the bank to cut 25 basis points in March. I think, given the slack we're seeing in labor markets, given the fact that interest rates are still in the upper half of where the Bank of Canada considers their neutral rate to be, the bank can look through some of this stronger data over the last couple of weeks and months. But if you go back to the December policy decision when these tax cuts were just being discussed and hadn't actually been implemented yet, Governor Macro made a comment that once these came into effect, he would expect inflation to be around 1.5% in January, we're obviously considerably higher than that. So I think the bank is going to be a little bit more cautious about continuing to ease going forward.
Okay, you mentioned that you're looking for the Bank of Canada cut in March, but you also mentioned inflation continues to be a bit sticky. Where do you see the Bank of Canada in terms of interest rates this year? How many more cuts do you expect?
So we look for 2 more cuts over the year. So that would be in March and in April. That would have the Bank of Canada bottoming out at 2.5%. But we do think that things would have to deteriorate a little bit to get to that second cut in April. Now, the bank is working off what we think is a fairly rosy growth outlook for 2025. They look for 1.8% GDP growth. We in the market are a little bit more downbeat on the 25 growth outlook. But I think, if you do see some of this labor market strength come off, if that core inflation momentum does start to stabilize over the next couple of months, that should be make it a little bit easier for the BOC to continue easing into Q2.
And given your outlook for growth, what's the general health of the economy right now?
I think the general health of the economy is looking pretty good here. Over the last couple of months, we have seen the labor market start to stabilize. We've been adding more and more jobs, and that's during a time where the population growth has been continuing to slow. So that gap between employment and labor supply is starting to narrow. You're also seeing this stronger performance for core inflation measures over the last couple of months. But I think the thing that the bank is also very mindful is that there are large risks on the horizon. Some of those risks are internal, things like mortgage renewals, things like debt service ratios that the Bank of Canada's been spending a lot of time over the last year. There are newer domestic risks like immigration and population growth and how that is going to unfold over the next 12 months. But there are also, external risks as well, and the bank will have to, account for those and adjust if needed.